Hedge funds seem to be capitulating, retail has sold at record amounts, and we're starting to see the signs of a potential tweezer bottom. So what does this mean for us as traders and investors? In today's video, we take a look at even more dark pool liquidity coming through at the key levels. And of course, we need to discuss whether the Magnificent Seven and other growth stocks have found bottoms. Could it be a dead cat bounce, or is this all part of a really bad setup that could spell disaster for markets? In today's video, we'll break down stocks, commodities, and cryptos to discuss it all together. This one's not to be missed. We'll see you in a moment, guys. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. Latest macro data, dark pools, options flows, and of course, the key levels that you need to be watching. In today's video, we need to go through, though, to start off with sentiment, because things look terrible when you're looking at generally how many people are starting to turn bearish on these markets. Record highs on the NASDAQ in terms of selling and put protection have just happened. And the last time we saw this was a major inflection point for the markets back in late 2023. When you look at the S&P 500, though, it becomes even more clear that we've only seen a few times like this. As you'll notice here, March 10th, September 23rd, which was a great low point or very close to the low point of 2022, and now March 4th. I think the notable thing here is 2 Marches have included these particular giant put levels. So what is this telling us? Well, it's telling us that sentiment is terrible. And of course, we've known this for quite a few days. The daily sentiment VIX index, and of course, in general, the sentiment reports we've been seeing from retail traders have been pretty bad. In fact, they're only marked really against 2009. And this is the nature of the push-pull market that we live in 2025. It's all about cutting through the news, cutting through the media, and cutting through the fear. Should we really be terrified, or should we be looking for opportunities in this market right now? Well, it does start to look like maybe it's opportunities. And as we've said, we hit a critical level being the daily 200 sentiment or daily 200 simple moving average on so many charts. We had synergy, which we love to look for here on the channels across so many different instruments in the markets. And another sign is hedge funds. If you guys know the stats on hedge funds, they don't tend to do very well over the long term. And guess what? They're totally freaking out. Over the last 2 weeks, they have sold at the fastest rate ever recorded. If you want a copy of this particular chart, jump on down into the pinned comments down below and follow us on X and other socials as we do post them there. But that is an absolutely wild statistic. At the same time, JP Morgan's retail imbalance survey has just found that retail traders 24 hours ago sold the most amount they've ever done in the first 1 hour of trade since recorded history. And that was $1.2 billion. I'm surprised they sold it right at the daily 200, but maybe we're not surprised. Peak fear potential. So of course, can we now see what we call a dead cat bounce? Well, of course, this will now be the discussion. Just as we see this, we see things such as the most ever outflows from the semiconductor market, the test of the 200-day moving average, which we thought would come, and of course, the potential bounce off that level. But the problem with all of this is that markets do look weak. And what that means is that there are some great internal structures and there are some bad areas. And as we know, as we see tariffs potentially go longer and longer and longer in terms of time on, these things can do damage. We've got positives being deregulation and tax cuts potentially on the horizon. And I think the market will make decisions on all of this soon as it finds out whether any of these things are going to get passed. Annualized returns, when we do hit the daily 200 after missing it the year before, as you'll notice here, 50% of the time we're up, 50% of the time we're down over that year. So this means that we're in that topsy-turvy market where it's up, down, and all around, and you've got to pay attention to everything all the way through. So of course, remember to subscribe to this channel because we're looking for the dark pools, we're looking for the options, we're looking for these key things together. Speaking of dark pools, everything that we've mentioned over the last couple of days, huge dark pools, huge VIX volumes, huge buys in what looks to be the Magnificent Seven style FANG stocks. These things have been happening, and it wasn't just there, it was the day before this as well, as we see here dark pools through all of these different funds, including the Qs. But over the last 24 hours, we saw another very interesting pickup, and that was Russell 200 Growth Fund. take a look at this. How many dark pools do you want at the bottom? The last time we saw such a cluster was over here, which of course ended up being selling, and we saw the markets move down, more selling, and then we moved all the way through to this point. But this is now 1, 2, 3, 4, 5 huge transactions all around the lows. And you've got to think that at least this could bring us the relief rally that many people are looking for. So this is not too bad. Again, with the tweezer, with the technical analysis we'll look at later, that is a very important sign for at least the potential of a relief rally. The problem is it's the volatility. Markets, at least great bull markets, kind of look like the way we had them for the last 2 years. Yeah, a couple of hiccups here and there, fairly fast kind of sell-offs, but in general, a slow, methodically paced, consecutive days with the S&P 500 moving up less than 1%. And it's these types of quiet strength confidence that generally builds the best bull markets. Are we in that in 2025? I think all of us know that is not what we're in. We're in markets that are going down 1.5, up 1.5, down 2, up 1.5, down 5, maybe not 5, but down 3, a very turbulent style market. And it opens us up to really starting to wonder whether we could be looking at something worse. Of course, when you've seen something like we did over the last week with down 1.5, up, etc., that still can lean into at least temporary strength for a little while here. But I think the key here is that the jobs numbers, which are coming out this Friday, might show us, or at least begin to show us, whether confidence is being lost on the hiring front. Private employers added 77,000 jobs in February, as you can see here, and hiring has slowed to the smallest level of gains since July, with trade and transportation, healthcare and education, and even information showing jobs losses. Small business employment is also falling. So we're clearly seeing a big shift here from being a very strong jobs number to potentially the next two to three jobs numbers being so important, as we see some government departments also have layoffs. This is also forcing its way through to the bellwether signs, which if you're not familiar with are quite a good eight kind of lead on the markets. And we only have one of them looking really good right now, and that has of course been the financials. If you take a look at everything else, well, they're not terrible, except for these are kind of bad over here. We have had, some weakness starting to show through. And as we see this, we've got to remember it's 1 foot out the door in 2025. And ultimately, there's going to be a lot of potential Trump puts and Fed puts put on if the market goes too bad. So at least initially, even if we do sell off more, there's probably going to be a good announcement from either Fed Chair Powell or Trump going, and changing a few things to try to push the market back up. There will be a level where you've got this pretty strong economy. I mean, you've got great earnings, which obviously came through. We've also got, of course, what has been looking pretty good in terms of the signs, but you also have other existential crises that are coming on top, including geopolitical tensions. So the Fed Chair Powell put potentially could be back on this Friday, and that's why he's talking after the jobs numbers. Now, could we be leading into then this type of scenario? This is from Grant Hawkridge, and you can see here that during January, we rallied up. We then sold off in Feb. We're now in March, which tends to bottoming the market, goes sideways, and then potentially rallies forward. If we follow that similar path, then things could still be looking good, but it may be a couple of tough months here. And of course, we'll need to be on top of those. But you've got to remember that right now, it's just rotation. During the start of 2025, we all spoke about this together. One of the big things that we were talking about was rotation. And we talked about healthcare, we talked about staples, we talked about defensive sectors, including gold, being potentially some of the best performers of 2025. And that's because we believe we're going from a mid-cycle to a late cycle style market. If you want to know about how we're making these kinds of calls as well, guys, and you ever want to educate yourself further than this channel, and there's a lot more to know, then of course do check out our advanced masterclass over on our website, fxevolution.com. But take a look at this. You've got a higher reading here in terms of higher highs across the board, even though the markets are coming down. And what that's telling us is it's showing us that basically we are still seeing quite a few small stocks doing all right, and the big stocks, that is the Magnificent Seven and the stocks that led 23 and 22 and 24 out, those ones are the ones that have been suffering. So it's those high kind of growth gamma stocks that we're getting a little bit overpriced. That's an interesting factor in itself. So while that is occurring and that's a good sign, ultimately we still need the biggest stocks to come with us. Why? They make up 37% of the market. Remember, the top 10 stocks are now concentrated at 37% of the S&P plus, and that is a problem when it comes to price action structure. Now, most bears are going to be going with a similar signal to this, and that is, did we just see a Wyckoff distribution? If you're not aware of it, basically we had 3 smaller highs, and that is part of what we call a Wyckoff distribution, and we've taken the low of at least one of the most recent lows, that 5,800 kind of level. Now, when we do that, if we don't bounce back above that level over the next coming weeks, that's a big sign that we have got significant weakness, and all of a sudden, we're down at 5,400 or even worse straight away. So this is still a critical point for markets. The only good sign is that we have those dark pools, we have that options, which you'll see in a moment in terms of puts everywhere, and of course, we do have the price action. So let's now also take a look at the flows for crypto. Crypto has been down. Over the last kind of 48 hours, we've seen 61.8 hold of the pool, which has been very, very good level. And so far, buyers have recommitted. You'll notice that even as of the delayed data here, which is the 4th of March, we've still got almost equal on Ethereum, and Bitcoin has stopped to shed as much. So I would expect the next day, which will be shown in the next video, that these will probably turn into positive flows. Let's now take a look at the S&P 500 just to see how important this level is to hold. As you guys can see here, here's the idea of the potential distribution. So you've got your buyer's C climax or your BC here. You've got your UT and your UTAD, which is all marked out before. And we've come down, we've kind of hit into what I would think is the last level, but a lot of people believe this is the sell. And then if it rallies up here, the structure could look like this. And of course, next up, 5,400. There's really nothing holding 57 to 54 in terms of general levels. Now, when we have a look at the futures market, you can see here the last 24 hours were better than not better because we held again the lows, which I thought we would, and we found buying pressure, but we still haven't got through that alert. Now, that's going to be a big turning point, 58.70-ish plus. If we get through that high, then all of a sudden we're saying, okay, maybe that's a temporary bottom. We can push towards just under 6,000, maybe 59.80. And of course, if we get through 6,000 plus, we're most likely going into what we call a positive gamma event. Now, what is positive gamma? It's when the options dealers have to hedge off into the positive side. So basically, in this case, what we're seeing is just puts everywhere. We are in classic negative gamma. Look at these puts everywhere. Everyone's on the put bandwagon. And usually when everyone's on something, the market will make as many people look as stupid as possible, which is one of our favorite quotes. And in general, the market could push up. Now, funnily enough, that 6,000 level becomes pretty tasty when you look at where the put level is in terms of everyone's been buying puts from that 6,000 all the way down. But the key, I think, is 5750, 5800. It still remains a very strong strike. And as we go through into Friday, you'll notice those strikes get even bigger, guys. And what this is telling us is that the market could have a little bit of a squeeze on it to push against this. Now, of course, there is always a flip side. This is negative gamma. If the market is, or let's say, going to drop itself and the pressures become too severe, then they can absolutely feed upon themselves. Hedging has to be done. This is negative gamma. All of a sudden, all the dealers are offside, and it can create incredible waterfall effects. That's a ton of puts. As we've just seen, the Qs and the S&P have some of the most puts on them ever that we've seen recorded. And that becomes important because while generally, yes, the market will buy off these levels, generally that'd be a statistic off these types of extreme levels. At the same time, if it does go bad, it gets really fierce really quickly. And we could be looking at 5,400 just like that. So you'll have to be risk managing yourself quite a lot over the next couple of days. Let's have a look at a few single stocks. First up, we'll look at Tesla, which a lot of you do like to look at from the options side. I still think the 250 is really the main key level here for Tesla. Yes, 270, 280 has a bunch of puts on it. Yes, we know 300, 310 is kind of the core level at the moment. But if I just noticed this, what is this $950? Who is this? I just had a look at this guy. Come on, look at that. I'd already looked at this chart before doing this video, but I just realized how big that is. That person is a moron. Anyway, that's okay. Other than them being a moron, and losing all of their money. Who knows what they're doing up there with that giant position. 250 is the major put level. And of course, we're seeing that on the charts as well. What do you guys think? Do you reckon that person's making any money up there at those 900 plus calls? I doubt it. Let's now take a look over here at the Nvidia position. 115 now, the major strike, plus 120. And for next week, so this is this week, 115, again, most traded zone, key level for semis to hold. And then we've got 125, 120 for Nvidia the weeks after. So really, Nvidia, all of these things have to hold up, and we do need to see some buying come back through. It's important that the structure holds and that, of course, we don't see a major freak out in certain markets. Now, speaking of freakouts, bonds markets are starting to price in risk. So although the whole way down so far, bonds markets haven't really been showing too much, you'll notice now that it is starting to accelerate here on one of our bond indicators. And this is suggesting that there's still a possibility of further drops. So the problem is, until we get past some of those levels, such as the S&P 500 level, yeah, the market's still a negative gamma. The market's still declining, even with the tweezer style bottom, which is not a bad sign. It's definitely a good sign for early adopters, for people that like to live a little bit dangerously. It still does have problems. And we're not going to ignore the longer term issues as well. Of course, the US 10-year spiked up recently after dropping off. Treasuries has therefore dropped, although I still think treasuries look pretty good. Home builders barely holding on to the level of demand. We've obviously seen semiconductors fall off as well. We've seen some weakness in the American consumer in terms of just general sentiment is going negative. The dollar has fallen off, which could be seen as a positive for certain things. Obviously a positive for the Chinese markets, which are up big today, 2.39%. We've been on that for a while now. So, of course, congrats if you're on that market. But again, the dollar falling down to this next level of support, it drops this level. All of a sudden, we're talking back around parity. And if we go under parity, then the dollar could be significantly weaker. Most of you guys are probably talking about oil at the moment, although I think it's a dangerous trade here. You'll notice that it is taking significant lows. And I don't mean just a little bit. We'll talk about this in our next video in more detail. But yeah, this is such a level for oil. Take a look at this. This level has not been broken for years. So we are seeing oil collapse. That could mean yield collapse. That could mean dollar collapse. And all of these things basically could be showing us that the QE has to come back. Basically, the Federal Reserve is going to have to step in and put the put in the system. And I think the market is trying to force that out of the Fed in some ways. Let's have a look at gold. Gold is, of course, a hedge against geopolitical concerns. Also does well in stagflation, which a lot of people believe we're going into. If you're not aware of what stagflation is, basically weak, easiest way to understand it, slowing or lower GDP, that is usually going backwards, and raising inflation. It's a very rare time in the markets. The 1970s were, of course, classic for this. And what did well during the 1970s? Funnily enough, during that period, you saw gold do well. You also saw some real estate do well. And you also saw, of course, oil. Now, that is not happening. So in the oil side, so we'll have to keep watching this one. But that is at least what people are thinking. And silver, second to gold, is breaking out. As we know, 32 plus, very strong, doing well. Congrats if you got on that one so far. Beautiful inverse head and shoulders style pattern, which actually proofs into 33. So still looking pretty good here for silver after that nice pickup. What about single stocks? Tesla, middle of nowhere in my opinion. It's oversold for sure. It hasn't filled gap. So you can see here gap would actually be lower, and there's still a gap even from high or wick to wick. So we're looking for that kind of 250-ish level for Tesla, or even the 220. That band down here seems like the most interesting buy level. And just remember, this sentiment on this stock is, of course, incredibly negative. So it's really about getting an oversold kind of read that is so extreme that you end up getting a squeeze from that in the options market. Nvidia, most traded zone, barely hold, but it still hold. And we go down to the daily. You can see here it's become an oversold market, similar to when we got an overbought market. And that does bode well, just like the synergies we're seeing with the NASDAQ, similar synergies with the Russell, synergies with everything else. Mag stocks also hit some key levels, previous resistance here from July and previous support from October, and they found some bounces. So this is the Magnificent Seven. And in general, in a nutshell, that's showing you some strength in what has been a pretty sell-off market in everything from Google to Microsoft to Amazon. And Amazon, I think, got the biggest amount of dark pool over the last 24 hours. and you'll notice here hitting into that nice demand. So again, could it be a bounce level? Yeah, I would say at least a temporary one. To get really serious, we're going to see 220 plus here, and of course those S&P levels broken through. Now, one of our favorites, healthcare, wasn't too shabby yesterday either. It started to keep going up. You know, defensives are doing well in 25, as we've talked about in our private community and here on YouTube. And we see, of course, another one of our favorites for this year, which has been Chinese stocks bouncing off the daily 20. Congrats to anyone that got that one. Actually, pretty good returns last couple of days off that trade. Let's have a look at the percentage here of increase. That is not too shabby, 6.61%. You know, China's a bit of a winner of this weak dollar, kind of everything that's going on, and we are seeing that flow through into global funds. US 2000, 2100, 10, 2120, that kind of thing. We're basically seeing a bit of a resistance here. If we do break to the upside, that's another good sign that things are improving. And NASDAQ, as you can see here, if we go to the daily, little tweezer kind of action going on, which is this 2 wick rejections off the base. These can at least cause temporary gains, but we've still got problems on the horizon. 21.2 plus, that's going to be an issue. And we do not want to drop 20,000 because if that happens, yeah, things are going pretty bad. Again, more Wyckoff distribution style concepts on these markets. Let's now have a look at the crypto market. Ethereum picking up a little bit. Solana barely picking up here, but still picking up off these lows. But the story is Bitcoin. Crypto reserve news this week. Of course, whatever's going on with that. And we saw that 61.8. We saw things from actually very replicable setups down here. A few guys in our community got this, which was pretty sweet. Not bad trading and very replicable, which is the key, I think, to all of this. And of course, we've since seen a market that's rallying up a little bit here. So, you know, it's going to face a big hurdle. Generally speaking, it's going to be that 100,000 number again. But yeah, things are looking good as long as it holds above the 61.8. And so far, it's really going to be, is this a pump and dump or is this just a pump and pump? And in general, I would say there are at least enough people involved in those markets to potentially want to pump and pump. But Bitcoin is going to be clearly the one that most people will be looking at. If Bitcoin can do it, though, I think other market coins could start to see sentiment improvement. And there are almost bargains out there with some of the massive sells that have happened through some of the alts. Guys, it really comes back to the crypto reserve information this week and, of course, the non-farm employment chains. Will we see some kind of Federal Reserve hints at QE or hints at some type of stimulus put to kind of support the markets? I don't know, neither do you. But ultimately, the price action is looking more positive. The tweezer is good. Obviously, it does bounce usually in these types of levels, and we've seen dark pools accommodate that at least for now. If things go bad like that Wyckoff, though, it could get nasty very quickly. So you've always got to kind of expect these things and risk manage accordingly. And as always, we'll be with you guys tomorrow after the close to break this all down together. Now, if you're interested in finding out more about what we do, follow us over on X. We do post over there. I've been posting a little bit on LinkedIn this year on my private account. So follow me there if you want to get that link. And of course, if you're interested in finding out more about how we replicate trades, how we've found things like healthcare and other sectors and gold over the last couple of years and stuff, then make sure to check out our advanced course or, of course, some of the others that we have there. Thanks so much, guys. You're awesome, and we'll see you tomorrow.